Okay, let's go ahead and get started. I'm happy to be moderating our next seminar in the Financial Literacy Seminar Series. Today, we're going to hear from Lisa Dettling, who's a principal economist at the Federal Reserve Board. She's going to be presenting work on the role of financial literacy in families having access to an emergency savings fund. Now, before I turn it over to Lisa, I just want to remind everyone about the Q&A process. We're excited to have people ask questions for Lisa, and so if you do have a question, please put it in the Q&A box, and I will be moderating the questions throughout the talk. All right, so with that, take it away, Lisa.
Great, thanks, Erin. Give me a second to share my screen. Oh, I think someone else needs to, yeah. Okay. Okay, so hopefully everyone can see. So as Erin said, this is a paper about financial literacy and liquid savings among U.S. families. This paper is co-authored with Neil Buddha from the Philly Fed and Jackie Blair, who's at Cornell. And of course, the usual disclaimer applies. These are my views and not the board's or the Federal Reserve Bank of Philadelphia. Okay, so the main motivation for this paper started with some alarming headlines that kept coming up in the news really before the pandemic, but have kind of persisted, that a lot of families might be unprepared for a financial emergency. And so this is kind of a famous cover of the Atlantic magazine, which says that, nearly half of Americans would have trouble finding $400 to pay for an emergency. And the author of the article says that, he's one of these people. And so then the sort of obvious follow-up question is, why aren't families prepared for a financial emergency? And one of the sort of first things that comes to mind is maybe it's just not possible for a lot of families to save. And so this is another headline that floated around the news in 2019. And this is an article by Elizabeth Warren, and it says, Americans don't need cliche financial advice, they just need to be paid more. And this started with a sort of Twitter back and forth between Elizabeth Warren and Chase, where Chase had come up with this story where they were saying, why is my bank account balance so low? And then, the bank account is, offering advice to sort of spend less money on sort of discretionary things. And Elizabeth Warren writes back and says, no, why aren't customers saving? And it's because, people aren't being paid enough to save. Another possible sort of explanation that's floated around about why people maybe don't have an emergency savings fund is the idea of portfolio optimization. And so specifically, there's this pretty well-known paper by Greg Kaplan and co-authors that talks about the so-called wealthy hand-to-mouth. And so these are the sort of what they say is 38 million American households who don't have an emergency fund or don't have, are living hand-to-mouth, don't have a lot of liquid savings, but have a lot of illiquid savings. And the argument made is that historically the returns to illiquid savings have been higher than the returns to liquid savings, for a number of reasons. So for example, the returns on housing and retirement accounts have been higher, and potentially in part because there's preferential tax treatment. And so someone who's optimizing their portfolio would choose to underinvest in liquid savings and keep their savings mostly in these higher return illiquid assets. And then finally, what's going to be the focus of our paper is the role that financial mistakes or lack of financial knowledge plays in sort of families not having a buffer of liquid savings. And so there's a number of previous papers that I suspect many in the audience are familiar with that have shown a link between financial knowledge and financial literacy and having an emergency fund. including some work, of course, by Anna Maria, that, financial education is associated with being able to cover emergency expenses, having precautionary savings, or having an emergency account. And so what are we going to do specifically in this paper? So first, we're going to address the first question that I brought up, which is just trying to answer how many families are unprepared for a financial emergency. And specifically, we're going to estimate savings across the income and wealth distribution using a nationally representative sample with a really comprehensive measure of wealth. And I'll get into a lot more detail about what I mean by that in just a little bit. And then after establishing how many families don't have an emergency fund, we're going to look into some explanations for why it is that people wouldn't have an emergency fund, focusing on those explanations that I brought up at the beginning, which is that how much of this reflects sort of low incomes and an inability to save, how much of it might reflect portfolio optimization, and then finally, the main focus of the paper is how much of this is explained by financial literacy. And so I guess I'll just check quick with Erin if there's any questions, or otherwise I'll just move ahead.
You can keep going.
All right, great. Okay, so the first part of our paper is just trying to quantify how many families lack emergency savings. So there's a couple of ways you might think about trying to measure emergency savings that various papers and surveys have used. So one of the first ways that's sort of kind of wonderful in its simplicity is that you can just ask families if they could cover a certain expense. So, the SHED, which is run here at the Federal Reserve Board, has a question which asks, how would you cover an unexpected $400 expense? Anna Maria has done some work on a survey that asked, how you would cover an unexpected $2,000 expense. I think that there's just, a few kind of obvious issues that come up with this approach. The first is that it's not family specific. So, a $400 might seem like a big expense to me, but might seem like a really small expense to you. The second is just respondent accounting errors. So asking someone if they could cover a certain expense might entail them mentally needing to add up how much money they have sitting in various accounts or sitting in cash at home. And I think that's naturally going to be subject to sort of mental accounting issues because that's kind of a hard problem. And then finally, an issue that every survey is going to face is how representative is the survey? Is the survey really representative of the entire population so we can make inference? So a second approach that has been used in the literature is to calculate savings relative to some benchmark. And this is ultimately going to be the approach that we're going to use, but with a bit of a twist on kind of what has been done in the past. And so income is a really obvious benchmark. This is what was done in Greg Kaplan and co-authors' paper. And many other papers. So thinking about savings relative to income can give you a sense of who's living hand to mouth. I think the issue there is that it's pretty well known that many people's incomes are volatile. And also there's a potential just for differences in cost of living. So, a certain income is going to have more purchasing power in different types of places and times. And similarly, the amount of kind of buffer you need might similarly be relative to the cost of living for your family. And so when thinking about a benchmark, we started thinking about what it is that financial planners often suggest for an emergency fund. And when you look across kind of the typical advice, a certain number always jumps out. And I just grabbed some pictures here from kind of random websites, but it's a very common piece of advice, which is that it's a good idea to have 3 to 6 months of your own living expenses in liquid savings. And so this is what we're going to try to operationalize in this paper as an emergency fund, which is how many people have 3 to 6 months of their own expenses in liquid savings. Now, of course, this is not going to be, exactly optimal for every family, but we think it's a pretty good proxy, just considering how common it is from financial planners for, what's approximately ideal for a lot of different kinds of families. And so how are we going to do this? We're going to use really detailed wealth data to calculate liquid savings. And then we're going to use a lot of really detailed information on families' own recurring living expenses and try to see how many families in the US are following these financial planner recommendations. So how are we going to do this? Our main data source is going to be the Survey of Consumer Finances, or the SCF, and we're going to use the 2016 and 2019 waves. Just a plug for my colleagues that are work on the SCF, the 2021 survey is probably forthcoming this fall, and so that should be exciting new data. It's the SCF is a nationally representative survey of household wealth. And what's great about the SCF is that it includes coverage of the very top of the wealth distribution, which means that you can do a lot of distributional stuff, including, measuring ownership of assets that are held by, a relatively few number of people. The SCF survey instrument walks families through account by account, what they have in different types of accounts. And so this really minimizes recall bias and sort of respondents having to do the kind of mental gymnastics that I was talking about earlier of having to figure out, savings in different kinds of accounts. The SCF lines up really well with national aggregates. And this is, because the coverage is good and it's such a detailed survey. And so we're going to use the SCF to construct a measure of total liquid savings. And we're going to be pretty broad the way we define liquid savings. So we're going to call liquid savings anything that can be accessed without a fee, penalty, or having to take a loan against that asset. And so what that's going to mean in practice is anything in a transaction account, checking, savings account, directly held equities, cash, anything on a prepaid card, or currently received retirement accounts. And then in some of our extensions, we're going to look at quasi-liquid savings. So for example, equities held in retirement accounts and housing wealth. And so these would be things that, can potentially be accessed in emergency, but it's going to require some fee or having to take out a loan to access that equity. Okay, we're going to compare families' liquid savings to their, what we are going to call normal or recurring expenses. And so what we have in mind here is the things that you need to pay for every month, but that kind of excluding, lumpy durables purchases and other kind of discretionary expenses. So things that, if, for example, maybe you've face some sort of unemployment spell, you would need to, the kind of expenses that you might need to keep up. So I'm sure some of you are thinking in the back of your mind who are familiar with the SCF that, I don't remember the SCF being explicitly being a consumption survey. So, how are you able to do this? But I'll note that actually most recurring expenses are recorded in the SCF in pretty high level of detail. And so we learn in the SCF people's monthly mortgage payments, their rent, any car loans and leases, their unsecured debt payments, and the amount they spend on food inside and outside the home. And then we're going to augment that measure with some imputed measures of their kind of monthly recurring expenses. So things like health costs, housing and vehicle maintenance costs, cell phones, cable, things like that. We're going to do this imputation similar to how Neil, Buddha, and I did in a previous paper, where we're going to base those imputations on the demographic and economic characteristics of the family. So for example, when thinking about housing and vehicle maintenance, we're going to take into account how many homes and vehicles you own, things like that. we do a lot of validation of our measure of expenses by comparing it to the Consumer Expenditure Survey, measures of total spending, less durables and discretionary. So the same kind of apples to apples concept of these kind of normal recurring expenses. And what we find is that the results line up really closely. So if we kind of look at the same income buckets in the SCF and CEX, we estimate expenses that are kind of within $15, so really close. And I think part of the reason we're doing such a good job is that the SCF expenses that we capture, when we map those to CEX, we find that it's about 2/3 of all recurring expenses. So we're getting a good, the majority of expenses from the SCF in the first place. Excuse me. Sorry. Okay. So this table here shows you SCF expenses by income quartile. And what you can see is if we move, the bottom line shows you total expenses. So what you see is if you move up income quartiles, not surprisingly, monthly expenses increase. To give you an idea of the income brackets here, the first quartile is people making below about $30,000, and the top quartile is people making above $100,000. A few of the other patterns are probably how you would expect. For example, housing payments, make up the bulk of most people's expenses. Yeah. Okay. So what do we find when we put this together and we try to understand how many people have liquid savings equivalent to at least 3 or 6 months of their own expenses, according to the financial planner recommendations? So the x-axis in this graph shows you the number of months of expenses, and then the y-axis has the percent of families. And so as you move across down the x-axis, it's telling you the sort of percent of people who have at least that many months of their own expenses and liquid savings. So focusing on that first point there, what we find is that about 49% of families have at least 3 months of their own expenses in liquid savings. And then when we move up to the 6-month cutoff, we see that 39% of families have 6 months saved. And so what this means is basically that just less than half of families are following the financial planner recommendations. So a good number of people don't have an emergency fund by this definition.
Lisa, we have a clarifying question that I think
Sure.
would be good to address right now. So do you assume that total household expenses are only the recurring and imputed expenses, or do you make an assumption about non-recurring expenses as well?
So we don't try to impute anything about non-recurring expenses. And we don't assume, and we basically are assuming here that the idea of an emergency fund is relative to those normal expenses and not relative to sort of durable or discretionary expenses, which I think, I don't know, I think it pretty well operationalizes the idea that financial planners have in mind, which is that, a lot of financial emergencies might be something like losing your job, in which case, you probably need to keep up these kind of mandatory, necessary, ongoing expenses, but maybe can defer some lumpier discretionary purchases. And that's kind of what we have in mind with this concept.
All right, thanks.
Okay. So as I said, about what we find is that less than half of families are following this financial planner recommendation that you keep at least 3 to 6 months of expenses in liquid savings. So we can also look across family types to see who has at least 3 months of their own expenses. And so here I've plotted basically the proportion of families in a bunch of different types of categories according to the how many have 3 months, at least 3 months saved. in liquid savings. I'll just highlight like a couple of interesting patterns here. So if you focus on income, you can see that as we move up the income distribution, more families have liquid savings covering 3 months of their own expenses. So for example, only 25% of families in the bottom income quartile have this definition of an emergency fund, whereas 76% of families in the top income quartile too. This is sort of prima facie evidence that, the kind of Elizabeth Warren narrative that I brought up at the beginning might be true, which is that, having an emergency fund is perhaps, something that lower income people just can't do. But of course, this is unconditional, and we're going to look into this in more detail in a multivariate framework later. If we look at sort of the groups that are have particularly low propensities to have an emergency fund, we find it's younger families and single parents. We also find that people who are not working are unlikely to have an emergency fund. One possibility here is that these are people that have sort of already dipped into their savings. One thing we also look at is family backgrounds. So what you can see here is that people whose parents were high school dropouts are much less likely to have an emergency fund than people whose parents had a higher level of education. And similarly, people who haven't ever received an inheritance or substantial gift from a parent or other family member are much less likely to have an emergency fund. And this kind of points to potentially an intergenerational kind of component to the lack of savings. Okay, so I'm going to move on now to looking at those different explanations for why people may or may not have an emergency fund, unless there's any questions, Erin?
Yeah, we have a few. So one is a question about whether people's recent use of the emergency fund. So can you see whether people recently used it and whether you're seeing the average size fund might be smaller for families who more frequently actually need to use it?
Yeah, I think that's an excellent question and something we're going to try to tackle in this next section. So as I said, the SCF is a really rich survey, and it has a lot of really interesting and in my opinion, perhaps underutilized information about things like how volatile your income normally is and whether you recently had an unexpected expense shock. And so we're going to include those things in our regression framework, kind of specifically to tackle this idea that, well, maybe you normally have a emergency fund, but you just used it, for some unexpected expense or income shock. And so we're going to think about all those things.
All right, I'll save some of the rest of them for later.
Okay, great. All right, so why do so many households lack emergency savings? So as I said at the beginning, one of the main things we're going to be looking at is financial literacy. And so we're going to use the very common financial literacy battery developed by Anna Maria and Olivia Mitchell. This battery, we're going to use the 3-question version, or the big 3. And so this was added to the SCF in the 2016 survey, and it's also included in the 2019 survey. And so for those, I imagine a lot of you are familiar with this, but if you're not, there's basically 3 questions here that refer to diversification, interest rates, and inflation. And what we're going to think about as someone who is quote unquote financially literate is going to be someone who can answer all 3 questions correctly. And someone who doesn't answer all 3 correctly, including someone who puts don't know, is going to be someone who is considered less financially literate in our framework, although we have done a lot of robustness on kind of different measures there. So when we look at the answers to the questions, how SCF respondents do in terms of answering the battery, This table here shows you, if you look at that second line, you can see that 43% of SCF respondents successfully answer all 3 questions correctly. This is reasonably similar to the results from other surveys where the battery's been asked. If you look across the 3 questions, you can see that the diversification question is the hardest question. I think this shows up in other surveys too. Only about 60% get that right. And then the easiest one is the interest rate question, where about 80% get it right. The SCF also has some other measures of financial knowledge. So specifically, there's a self-rating of your own financial knowledge. And so this, people rate themselves on a scale of 1 to 10, whether they're not knowledgeable or very knowledgeable. I've scaled it from 0 to 1 here, so you can see the average is about a 7. In terms of kind of how to interpret that measure, I think my read is that there's not a total consensus in the literature for kind of how to think about that conditional on the battery. Some people think it may just capture kind of other dimensions of financial knowledge. Other people think it might kind of capture something about confidence. If you look at how financial literacy and self-rated financial knowledge relate to each other, so here I've plotted people's responses to the self-rating against the percent of folks in each self-rating who got the financial literacy battery correct. You can see that there's clearly a positive correlation. So people who think they're more knowledgeable tend to be more knowledgeable until you get to the very top, where there's this kind of well-known finding that people who rate themselves a perfect 10 tend to perform more poorly than people who rated themselves, you know, an 8 or a 9. We also are going to look at formal education. So because they, you know, that might also capture some other dimension of learning about financial topics, for example. And if you look by education, you can see, you know, financial literacy is also correlated with formal education. So people with higher degrees are more likely to get all 3 questions correctly. In terms of the types of other variables we're going to think about as predictors of having an emergency fund, this goes back to the question that someone had just asked. So we're going to look at income. We're going to specifically look at normal income. For those of you who aren't familiar, this is a measure in the SCF that's designed to approximate permanent income. And so what the survey says is, what was your income this year? And then they ask, well, what's your income in a normal year? We're also going to look at income shocks. So whether you recently had a positive or negative income shock, as well as whether or not you've recently had an expense shock. We're also going to look at things like family structure and family background, and specifically, you know, these proxies for whether you might have had some sort of intergenerational transfers or help that might help you accumulate savings. So we're going to use a really straightforward empirical approach. So we're just going to use ordinary least squares to estimate the relationship between the probability a family has at least 3 months of their own expenses in liquid savings. Relating that to financial literacy, again, defined as it says percent of questions correct, but that's not accurate. It's whether or not you got all 3 correct. So it's going to be an indicator variable too. The control variables are going to be, again, those things I just described. So income, self-rated financial knowledge, education, family background, etc. So moving on to the results. So here is our kind of main takeaway table. And so if you look at that first column there, we're just showing you the raw unconditional correlation between the financial literacy measure and having liquid savings. And so what you can see is that answering all 3 questions correctly is associated with a 18.5 percentage point increase in the probability that you have 3 months of your own expenses saved. That's about a 35% increase at the mean, so pretty sizable. When we start adding more control variables, the first thing we do is add the self-rated financial knowledge. So you can see there is that it doesn't move the financial literacy coefficient too much, but it clearly has some signal on its own. So they both seem to predict the propensity for someone to have an emergency fund. Next, we add in those measures of income. There's kind of two things that stand out here. First, you can see that the financial literacy coefficient falls quite a bit, and so, but remains positive and statistically significant. So we can see that it's still the case that financial literacy predicts having an emergency fund, even conditional on all these different measures of income and kind of recent shocks. So, but you can see income seems to matter too. And so this would be kind of consistent with that, potentially consistent with that narrative that, you know, people's savings or decisions are determinant on sort of their income levels. And the income coefficients kind of have the pattern and sign that you would expect, you know, positive income shocks increase savings, negative income shocks decrease savings, that kind of thing. What's kind of interesting when we look at the magnitudes is that if you compare the coefficient on normal income to the coefficient on financial literacy, you can see that answering all three questions correctly has about the same effect on the probability someone has an emergency fund as a 60% increase in income. So that's a pretty big economic effect of financial literacy. We also include controls for your own education, which doesn't sort of move the dial too much in terms of the literacy coefficient. And again, the sign of the coefficients is exactly what you'd probably expect. And then finally, we add those family background variables, again, like similar assigned coefficients to what, you know, we might have put a ex ante expected. And in that final column, when we include all of the different control variables in the model, we can see that answering all three questions correctly increases the propensity if someone has 3 months saved by about 8 percentage points. So it's about 15% at the mean. Okay, so now returning to those sort of hypotheses that we threw out in the beginning about why it is that people don't have emergency funds that have been sort of floated around in the media and the academic literature. And so the first was sort of, you know, is it that people can't save or that they're choosing not to save? And so this was the sort of article by Elizabeth Warren that said it's that people's incomes are just too low to permit savings. And so one kind of testable hypothesis that comes out of this is that you would expect, if this is true, there may be a limited role for financial acumen amongst the lowest income families, since savings for them is not an active choice. You know, they're just constrained in terms of their incomes. And so it shouldn't really predict whether they're saving or not. You know, the flip side of that, which seems like it could also be true, which is that, you know, higher income families might just passively save because you know, their income is sufficiently high that they just don't need to spend it all. In which case, again, like that might predict a more limited role for financial literacy among higher income families. And so we test this in a really straightforward way by just splitting the sample by income tercile and looking at whether there's a differential effect of financial literacy across the distribution. And these regressions include all those same control variables that I mentioned before. So what we find from this, if you look across the distribution, is that you'll see here the coefficients are roughly similar magnitude. But if you remember from earlier, the probability of having an emergency fund so the mean of the dependent variable is much lower at the bottom than the top. And so when we look as a sort of percent of the mean, we see that actually financial literacy is a lot more important for predicting the propensity to have an emergency fund at the bottom of the income distribution than it is at the top. So at the mean of the dependent variables, the effect is about 26% at the bottom of the income distribution and about 13% at the top. You know, that said, what we see is that across the distribution, it seems like financial literacy matters for all different incomes. Maybe this is a good place just to make sure there weren't questions there.
Sure. Going back to just a couple things about the analysis. So just kind of the raw numbers that you found of, like, you know, what percentage of households have that buffer. Was it surprising to you to find that around half of households had that buffer for the 3 months, like relative to your own expectations or relative to the literature, or was that kind of what you expected to find?
I'm not sure. So I think if you followed what, for example, that article in the Atlantic was saying, was that half of people don't have $400, and certainly that's like well below 3 months of most people's expenses. So if you took that seriously, which I think we all know there's like some flaws in that the interpretation there, you might have thought that so many more people wouldn't have had 3 months of their own expenses. But I think like from spending a lot of time working with the SCF, I had a feeling it was like probably a pretty high number. So I'm not sure, like I'm not sure if I was surprised or not, to be honest. I don't know.
Fair enough. One other question about a different breakout potentially you could do. Did you consider breaking out families by the proportion of their recurring expenses as a proportion of their income, like people who, right, are just spending a lot more, like on rent or whatever it is, and whether, you know, those folks are more or less likely to have a buffer fund?
Yeah, no, that's a good question. I'm not sure we ever did exactly that. Yeah, that's a good idea. That would be cool.
All right, I will let you keep going and save
some
of the rest of these for later.
Okay, great. Okay, so the next thing we did in our analysis is to start to think about illiquid savings. And I'm going to use this kind of like in kind of a general way to mean assets that you know can potentially be accessed in a financial emergency with some sort of hoops. So maybe you need to borrow against those assets. Maybe you pay some sort of fee or penalty for extraction. But we know that it's not uncommon for people to access this kind of equity. So, for example, there's a lot of research showing that quasi-liquid retirement accounts like 401ks, people borrow against them fairly commonly. And we know that also home equity extraction is fairly common via either home equity loans or lines of credit. And so it may be entirely reasonable for some people to focus their savings on these kind of assets instead of the liquid assets that we focused on earlier. And so the next thing we're going to do is ask how many families have 3 to 6 months of their expenses, but once we use a more inclusive measure of kind of assets that might be tapped in an emergency. So specifically, once we add in quasi-liquid accounts, so things like retirement accounts, certificates of deposit, whole life insurance policies, things like that. And then also real estate that'll potentially home equity could be extracted from. So this is going to repeat that same style graph I showed in the beginning, where the x-axis shows you months of expenses and the y shows you the fraction of families that have that many months, at least that many months. And if you remember, this is the picture from before where on the left, where you can see about half of families have 3 months saved in liquid savings. And then if you look on the right, we add quasi-liquid savings in the dashed line. And then in the solid line, we add both quasi-liquid savings and real estate assets. And so when we look there at the 3-month mark, we can see that 66% of households have 3 months in either liquid or quasi-liquid savings, and that about 79% have 3 months saved in liquid, quasi-liquid, or housing assets. And so that means that there are some people who don't have liquid savings, but do have these other kind of assets, or have very small amount of liquid savings, but once we add in these other kind of assets, have at least 3 to 6 months. So that brings us to this idea that there are people who may have actually pretty substantial illiquid or quasi-liquid assets and pretty limited liquid savings. And so when we look across, what we do to look at that is here we're just splitting by illiquid wealth tercile. And so if we focus on the top group, these are people that have about $200,000 or more in illiquid assets. We find that about 80% of those people have 3 months in liquid savings. But what that means is that 20% of them don't. And so these are the sort of quote unquote wealthy hand to mouth type families. So these are people that have a lot of savings in illiquid assets, but very little in liquid assets. And so then we're going to look into sort of the explanations for why these people are behaving in this way. And so one of the key propositions in Kaplan and co-authors' paper is that the returns are higher on illiquid assets. And so therefore it's rational to underinvest in liquid assets. And if you look historically, it's true that the returns on illiquid assets are often higher, and also that these types of assets also often have preferential tax treatment. So for example, money in retirement accounts has a better tax treatment than money held in sort of directly held equities, say. So it may be that financially savvy households are choosing this portfolio allocation in order to optimize their returns. And this leads to another testable hypothesis, which is that we might expect then a negative relationship between financial literacy and holding liquid savings for people with really high levels of illiquid wealth. So these would be basically being financially savvy would lead you to reduce your liquid savings and keep only illiquid savings. And then the flip side is, if this is about financial mistakes, we would expect financial literacy to increase liquid savings throughout the wealth distribution. So what do we find? Here we've did a similar analysis to what we did by income, but instead we're splitting by illiquid wealth and looking at the relationship between financial literacy and the probability of having a 3-month emergency fund. Again, controlling for all the variables that we controlled for before. What we see is that financial literacy predicts families being more likely to have liquid savings throughout the wealth distribution, including for that top tercile of wealth holders. And so this suggests to us that financial mistakes seem to explain at least some of this wealthy hand-to-mouth behavior. So people holding high level of illiquid assets, but not any liquid assets. So if we look at sort of the effects at the mean, you can see the effects are largest for the lower wealth families. So about a 30% increase in the probability of having 3 months saved if you answer all 3 questions correct relative to not, and moving up the distribution up to about like an 11% increase, but still not negligible. Okay. So I'm going to wrap up then. So what do we find in this paper? Basically that half of families have less than 3 months of their own expenses in liquid savings. And this includes 20% of the top tercile of illiquid wealth holders. When we look at a multivariate framework, we find that financial literacy is strongly correlated with having 3 months of your own expenses saved. And it has an economically large effect. So in particular, we find that the savings boost from answering all 3 questions correctly is about equivalent to a 60% increase in normal income. This correlation between financial literacy and savings is consistent with some prior work. And our paper kind of adds to this literature by using a quantitative measure of savings and expenses, kind of following this financial planner rule of thumb, and using a nationally representative sample. When we look across the income and wealth distribution, we find that financial literacy is predictive of having or not having savings, even among wealthier families. And so this suggests that this hand-to-mouth behavior is partly about financial mistakes and not entirely about portfolio optimization. And we find that financial literacy is predictive of having an emergency fund has the strongest effects among the lowest income and the lowest wealth families. And so that means if we're thinking about kind of policies to reduce financial fragility, it does suggest that financial education could improve preparedness for emergencies kind of across the distribution and specifically for these sort of low income, low wealth families. So that is all I have, but I'm happy, of course, to answer questions.
Great. Thank you, Lisa. That was a super interesting talk, and we have a lot of questions. So I'll start. We've got a couple of questions that are about access to credit. So one of them is kind of, you talked about the like other surveys getting at, access to emergency savings. And so what do those surveys do about asking people about other options that they have to cover the expense? And then there are other questions sort of about like in your analysis. So, how have you kind of thought through, have you been able to do anything with access to credit? And one suggestion is, could you put that illiquid asset variable in your regression and as a control and kind of see if like that, is sort of maybe a proxy for access to credit, and like, does that, the effect of the financial literacy coefficient, does that sort of change the coefficient?
Mm-hmm. Okay. Great. So I think the first question is, if you don't have is kind of, at least the way I'm interpreting it, as if you don't have an emergency fund, say, well, what do you do if there's a financial emergency? And it's right. A lot of surveys have asked people how they would cover an expense, with emergency savings being just one option. So other things people talk about or respond as how they would deal with an unexpected emergency expense, and Erin, you probably would know the numbers on this better than me, are, for example, in the shed, they'll ask, oh, maybe you'd put it on a credit card, maybe you'd borrow from friends and family, things like that. We are sort of intentionally abstracting away from those options, in part because if you kind of read what financial planners say about why it's a good idea to have an emergency fund, they'll cite things like, so you don't have to engage in high cost borrowing and things like that. And so I think, that's an important, although some people say that's what they would do, is that optimal if you're going to have to pay some fees later to do that? I think another thing that's often in these hypotheticals, people say, oh, I'd borrow from friends and family. But I think one thing to think about is that, a lot of financial emergencies happen from common shocks. So the pandemic hits, a lot of people lose their job. You have stomach bills you need to keep up. It may be that all of your friends and family are facing that common shock at the same time. And so as a backstop, it's not clear that's always going to be available, even if it's available right now. And so I think that's one of the reasons why having an emergency fund instead of sort of relying on borrowing is important. And I think like similarly, credit supply from banks can be sort of hard to obtain if the shock is that, say, you lost your job. And so I think that's one of the reasons we focus on emergency funds rather than kind of some of these other borrowing channels in what we're doing. But it's definitely true that I think a good number of people say that is what they would do. And then in terms of sort of whether what we know, say, in the SCF about access to credit, so there are some questions for those that are interested about trying to capture the incidence of credit constraints for SCF respondents. So there's this like common battery of like, were you denied credit or didn't apply because you thought you'd be denied? And there's also some information about whether you could borrow money from friends and family members. I think it's like $3,000 or something like that. And so I think, that's something we could look at, although we pretty much abstracted away from it for the reasons I just suggested here.
Great. Okay, so there's a question. I mean, to me, this kind of gets, it's a technical kind of question about a calculation, but I think it kind of gets to the heart of what this paper is trying to do, which is like, what matters? Is it income or is it financial literacy? And it sort of sounds like, in this paper, you kind of say, well, both. And so the question is there a way to do some sort of decomposition to kind of see like how much of the undersaving is due to income and how much is it due to financial literacy?
I think like the most straightforward answer is, I think you can probably do that from the point estimates that we come up with in the sort of horse race where we have everything in there. And we see that everything matters. I think like the only comparison that we've like explicitly done in the paper so far is that comparison I mentioned. I think it's like on this slide, where basically financial literacy is equivalent to like a 60% increase in income. I'm not sure we've done like something where we've said like, yeah, I'm not sure we've done that exact composition, like X% of the lack of saving is due to X, Y, and Z. But I think in principle, you could do that.
Okay, so I think maybe hopefully, I think we have time for a couple more. So one is thinking about other things that might be coming into play. So we know that education is a big driver for financial literacy, but other things like stress factors could come in to kind of also prevent savings behaviors. So is there anything in the SCF that does the SCF ask about any of those sorts of things?
That's a good question. I don't think so. I'm trying to think. I'm not exactly sure. Let me think. I don't think so. I mean, there are a lot of questions, but I don't think there's anything explicitly about like whether you've worried about your finances recently or something like that. But maybe I'd have to go back and confirm.
And so thinking about kind of mechanisms, so why do you think financial literacy is so predictive? Like, what is it about that is really kind of, what is the driver there? Like, why are families with low literacy not kind of able to save? Like,
I mean, maybe it's just not prioritizing saving, I guess, is one possibility. Although, honestly, I feel like Anna Maria probably has more thoughts on this.
It's really great. There are like lots of questions here, but I'm just going to take maybe a couple of minutes to say, I agree with you, Lisa, that, I think is, knowing the ABC of finance is pretty helpful. It actually shows, for example, that you do need, for example, to have that, minimum amount of savings, and that saving can be very protective. And you feel like, it is so basics, but, financial literacy can be very helpful to emphasize, for example, the need to have saving. And I think perhaps one of the things we have used in other model is that people do not have financial literacy, just consume all of their income. That perhaps is their rule, right? And that's a pretty bad rule, for example. And I just want to mention, and maybe ask to you another question, Lisa, which is, do you think that your data says that we need financial literacy for every income or wealth quartile?
I mean, it certainly seems to show that it matters for having an emergency fund. And like when I read the anecdotal kind of evidence, like for example, that Atlantic article about someone who was very high income, who was living hand to mouth, it does suggest that maybe it would move the needle. I think all of the results spot across all of the sort of distributional stuff we've done, where again, like we're allowing all those other variables to interact within these sort of say high wealth and low wealth, high income, low income families, you see financial literacy being really important for predicting whether they have an emergency fund. And so it does seem like, to the extent that we think financial education improves financial literacy, then yeah, I think so.
Yeah. So on that note, I just wanted to, first of all, thank you very much for being here today. And I'm actually just going to spend a few minutes just saying how important this paper is. First of all, if you look at this data, this is before the pandemic. And this is actually at a time of economic expansion, particularly 2019. This is 10 years after the financial crisis. So even in a time in which the economy is doing well, basically half of the family in a sense, do not have the type of precautionary saving that would buffer them against a shock to income that at least lasts 3 months. So as you can imagine, take a pandemic and, imagine what would happen to families. And this is why I think, first of all, this is important work. And some of the people were asking as well, there are now proposals even in Congress about should we promote precautionary saving? It's very interesting that, there are all of these tax incentives indeed to promote long-term saving, but how about short-term saving? Because it does have an effect, not just on the life of people, which is very important, but also on the financial stability of the economy. And so, I think there is really a lot we can learn on this work, and I think is really timely. We have spent so much time and so much work on, for example, saving for retirement, and I do think less work on the saving for the short term, on the precautionary saving, but they are very important for the economy. So I want to thank Lisa for this great work, and I also wanted to tell you this is already a paper that is going to be part of a special issue on a journal on a special issue on personal finance. And I hope, Lisa, that you'll continue to do more work on this, because I do think that there are a lot of questions, and many of the questions were asked here as well, because I do think this is work that can also influence policy. And I also cannot say how happy I am that now the big three are also added to the survey of consumer finances. I think, this is one of the best survey, the survey that is most, most precise when we look at wealth and wealth holdings and so on. And so, this is certainly something that we can use now a lot. And I think it's really great. I don't know where the new wave is coming out. Some of the people were already asking, what's going to happen to these precautionary saving after the pandemic? What has happened? Are now family, having much less saving? But of course, there has been also the help of the government. So what's the situation now? So I think we would like to invite you back if you give an update of what's happening to the family now, because indeed it is a big question. And I think another important question is, how can we help families, in particular the low-income families, build more security, more financial security? And this short-term financial security can have huge implication as well. So, we were so glad to have you here today to present this work. And for all of you, we had a big audience today. So I'm sorry we couldn't take potentially all of your questions, but we will post the paper. So make sure that you read this paper. I don't know if we can also post the presentation, Lisa. But we will be very happy, because I think there is really a lot of interest on that. And stay tuned for the next coming up seminars. They are posted on our website. There might be changes, maybe in dates and so on. Please so check back again. And let me thank all of you who were here today. And thank you and goodbye. Thank you, Lisa.
Thanks.